Hey, greetings, and thank you so much for joining us. It's Macro to Micro Options Power Hour. I'm Samantha LaDuc, founder of LaDucTrading.com, East Coast, Boston area. I'm joined by Hans Albrecht, our derivatives contributor partner extraordinaire, and he's on West Coast, Toronto area. So we're coming together to talk the market in language of options, as well as what we see moving forward. Event risk, unusual activity, the plumbing, if you will, not to mention direction and sector rotations and stock selection. But we are also open to Q&A. So we do this for clients during the day. Hans has his own channel in our Slack member workspace, and he also provides programs, and we have greatly discounted programs for members to his options education program. I just want to say thank you for joining us. And Hans, I'm going to throw it over to you and introduce a little bit about yourself, since we're kind of starting this webinar series. And today is our first one that is public facing. We have done them for clients. We did one yesterday, last week, etc. So give us a little background about yourself.
Terrific. Thanks, Samantha. Yeah, coming to you from the edge of murky Lake Ontario, which is apropos these days because this market is murky at best. I don't think anyone has it figured out, neither Powell nor you and I, but we certainly try, and that's what we do at LaDuc. We give it our best, and I have to admit, you've been pretty spot on lately with a lot of your calls. So a little about me, former options market maker, so about 12 years as a pro options market maker, one of the youngest ever on the floor. So the old trading floor with all the hand signals and yelling and screaming and all that fun stuff. And then ran a number of overlay ETFs, so a number of option overlay type funds, cover call, put sale, downside put protect, black swan type funds. So a little bit of everything, right? Income, protection. And so a really good sort of background across the spectrum of strategies, which is good because with clients, I always like to focus on a lot of things that they want, which is income from options, but at the same time, it's just in my DNA to be careful. I've been through 4 or 5 bear markets, and I've seen what can happen out there. So we like to focus on offense, but we always like to have an eye towards defense as well. So I bring some of those skills and a lot of that experience to LaDuc. So I'm really thrilled to be here.
That's one of the main reasons that I was really excited about working together. And this was several months ago. We kicked this off, brought you in for clients, because one, we have clients that manage other people's money, but also their own that are focused on capital preservation. Like you mentioned, you've been through some bear markets. So how best to hedge and overlay strategies. And then we have, of course, I run a live trading room. So they want to chase, they want to swing trade. And that's where I really get into stock selection and sector rotation. And there's a lot of directional juice there that we're trying to squeeze. We love volatility. So I know that you do a bit of that as well, and you post your trades. Some are a little bit more, financed call spreads and put spreads and the like. They're not just directional 0 DTE, which I know neither of us are really that excited about. But the point is, this is where we can really also kind of focus on the alpha. So I wanted to make this available, since we've been doing this for clients, public facing. So if there are folks that follow us on Twitter, for example, we'll post it on the YouTube channel, post it on my website, which is also where you have your partner page. We'll have a chance for folks to get a sense of our analysis and then how we manifest that with options. And of course, across asset classes, across different time frames. And then just to kind of open it up to live Q&A, and not as much on the macro, which I have done in the past on these kind of public-facing macro to micro power hours, but how to play directionally and or hedge, like right now with escalation in the Middle East. I think we're really going to get some engagement, and that's what I wanted to do. So if this actually is helpful for folks, then you can hit us up with questions in Zoom Q&A. That would be absolutely fine. Now, before we get to Zoom Q&A, and you can hop on, if you see something that you're hearing from either of us, then definitely hit us up with a question. But for the most part, you have some charts that you want to showcase, and I don't want to delay from that, but I did want to kind of get into a conversation about how we see the market direction and then where we could see some really viable hedges given uncertainty that's unfolding right now in the Middle East. Thoughts on that?
Yeah, so I mean, look, it's a volatile situation. Interestingly, and we talked about this yesterday, the VIX is being fairly reactive, but not overly reactive. We're not getting that sort of really sort of scary reaction that we saw in early August, a little bit in early September as well, as when we saw the VVIX really go nuts. And so, just people keep hearing these terms, and like we needed to make this world even more complicated. Now we have the VVIX to talk about, which is the volatility of volatility. It's like, derivatives are an awful lot of fun, aren't they? So but that's one more thing that we like to watch. And we saw the VVIX go crazy in early September. So we have this volatility echo that's happened. And so anybody out there watching who's been paying attention to the VIX may have noticed that the market hasn't been really all that volatile lately. We had that big pin last week that we talked about, that JPM collar. So we sort of, it was like a big ShamWow kind of sucking up all that, there's my ShamWow term again, Samantha, sucking up all that volatility as dealers have to hedge back and forth. And I'm going to show you a chart in a little bit that alludes to what happens in those kinds of situations. And again, we had this very interesting lack of volatility, a little bit of a knee-jerk reaction down yesterday into that very terrible geopolitical situation. But we bounced right back again. And so there seems to be this sort of willingness for stocks to kind of weather whatever the news is. And I find that kind of interesting. But I think more and more, and we've talked about this in the past, I think more and more it's very much a vol clustering kind of market. And what that means is either people are panicking and that can snowball to the downside as it did in August, or we're just really shrugging off almost everything. And I find that investors are having a difficult time with that, and traders in particular. It's one or the other. Dispersion trading has become very, very difficult because of this particular effect out there. So it's a tough market for sure. And I think you need somebody. And what I love about what you do, Samantha, is you really look at the different time frames. So you give people the overall look. So there's that old saying, the forest for the trees. So you can't get too stuck in the trees, because then you forget about the forest. You forget about the larger trend. And so you kind of always have to have this multi-tiered approach that has kind of one eye on each of the various time frames. I love that about it. Sometimes when you zoom out in your charts, I go, oh my goodness, I should have been looking at the weekly or the monthly, because that is a really, really important thing to notice.
So the thing about this time frame congruence for me, it really is secret sauce for technical analysis, because it helps kind of explain it, where the intraday charts that everyone gets so excited about, because that adrenaline rush is like a child running around, really, and there aren't a lot of guardrails. The daily chart, which more swing traders tend to focus, is more like the parent, right? A little bit more experience, not as fast moving. And then the weekly chart is the grandparent, and they have a lot of authority. And if you go to the monthly, it's the great grandparent, like all hail, like you're not going to say no. So the point is, they have a lot of guardrails that make sure, at least for me anyway, that a range, a movement is quantifiable. So that's why I use that zoom out kind of approach. And I do actually love these counter trend bounces, right? Like we talked last week for clients, I was recommending short TLT, and you set up a trade as an example. It also helped with that sector rotation that I said we're going to have some digestion in XLP, XLV, and they're all kind of that bond proxy. They come back with a yield spike. And ironically, I called that on Fed Day, the morning of, because it was time, technically, big picture, for a really strong kind of support level that I could see on the monthly. So the point is, yes, I do use time frame congruence. It's a little bit unusual, and you're studying the option dynamics. So not to digress,
I'd say
that's why it works.
From that perspective, I think that is why it works, because from that perspective, I find a lot of option traders are kind of in the trees. So the sort of noise that you're alluding to, this kind of like the kids are running around from minute to minute, anything can happen out there. Simply because markets are open, throughout the day, and very reactive to headlines and whatever's going on. But And so that the interesting part to me is that let's say as an option seller, I'm focusing on 30 to 40 day options, for example, where that nice fat kind of part of the theta curve is, where you don't get too close to the strike, too close to expiry, where you get that short gamma. So you want to kind of find that sweet spot. But that tends to be 30 to 40 days. And so,
Mhm.
but the risk of focusing a lot on that is that you forget that bigger picture. And so, you picked up $7 selling Apple puts, but you missed $75 on the way up on Apple. And so what I try to do is kind of bridge those two worlds, because I very much do, it irritates me to lose a lot of upside. So my system involves really looking at various pillars of edge that kind of inform me as to where are things going? Are they going to sit around? Well, okay, then we're going to sort of crush the premium and sell some options and generate some premium harvesting. But if the market really wants to go, if the VIX is 12, 13, I've sort of trained myself over the decades to say, well, you know what? Sometimes it's good to step back. So I also like that sort of toggling back and forth between those two worlds, because I think they're very important and complementary, but sometimes you need to focus more on one than the other.
And it depends on the events, right? So the August VIX explosion to 65 pre-market on a Monday was very much triggered by currency volatility. That absolutely triggered equity volatility, and VIX exploded, third largest spike, but it was pre-market, right? It came down very quickly. So it actually skewed a lot of my ratio analysis. But anyway, this most recent one that we had was very much the Middle East, escalation. So that was folks, in my humble opinion, just clamoring or scrambling for hedges they didn't have. And it's one of the reasons why it may not have been so sticky. Right now it's still sticky. I mean, it was 16, it's now 19. But I mean, big picture, we haven't had a higher reason to spike higher, but folks were clearly not expecting and therefore not protected. So that's why we went and did a session yesterday for clients at 1. Let's talk about hedges. Let's talk about how to trade an oil spike. Let's talk about these things, because even though you and I have both been like, yes, the market sees 6,000. I've got 58.20 to 60.10. And now the JP Morgan caller just came out, and it is in fact 60.20 is the sold call, which is consensus, right? But before that, we have to get through a very choppy October and election unknown. So let's talk about how to play the waves.
Right, exactly. And this is it. So can you see my screen here, Samantha?
Absolutely. Yep.
Okay, so yeah, so this is kind of our situation. So for folks who haven't seen this sort of gamma map, this is, we had that collar. Here we are at 5,800. Here we're there's 5,600, 5,800. So we had that very, very big collar right here. So you can think of this big, large green line as this large tree. And this tree was over here for that collar. So it was sitting there acting as a call wall. And the market was kind of ends up getting pinned to it. And I did this for a living. As you get close to that strike, you're selling futures, or sometimes you have to buy them back if you get too close to expiry. That pushes us towards that strike. And then above the strike, dealers have a whole bunch of stock and futures to sell. So that creates a huge supply above the strike. And so back and forth we go until the volatility just keeps getting narrower and narrower. And we have this sort of this pin, they call it sort of a pin. And so right now we had it move out. And so you talked about where it is now, above 6,000. So we've got this collar, lots of gamma up there. So, and it's 3 months away. So you have more gamma when it's expiring tomorrow than you do when it's 3 months from now. So right now we have an interesting situation. So as we look back and we look more at the forest rather than the trees, we have to notice, and we look at this every day. We notice that we're going to be in a negative gamma situation. So all you guys have to know is, when we get into all this kind of weird stuff, is when dealers are long gamma, less market movement. When dealers are short gamma, that's potential for more market movement. We call that an accelerant. So if we get below 5,600, and remember, this is just one piece of a big puzzle that we call markets. and derivatives markets in particular. But if we get below 5,600, and interestingly, yesterday's event did not get us below that level. If you thought there could be a big event that could push us down there, maybe we were sort of, we were remembering April where we eventually just shrugged it off, and Israel and Iran kind of lobbed a few softballs at each other, and then it was done for a while. So maybe the market kind of figures it's going to be that kind of situation. I think there's more risk in an escalation, much more than in April. However, we've shrugged it off. But these are going to be some of our levels, and I'm sure you talk about them in the morning on your call. You do a call every morning, and for the members to inform them. If we get below that 5,600 level, we get into negative gamma. And what that means is dealers have to sell into the sell-off as opposed to buying into a sell-off. And that's what really makes the difference between positive gamma and negative gamma. Are we in an accelerant? And we don't know what starts that. It needs an event, but we don't know what will get us going. But when we do get into those areas of negative gamma, we can push even more strongly to the downside. So again, talking about vol clustering, okay, either nothing's happening and we're just kind of chopping around, or all heck is breaking loose if we're in this part. So it's weird. It's sort of like if we're down 1%, they're going to buy every 1 to 2% down sort of move. But if we get down 4%, we could turn into a down 10% easily. So it's almost like, I have an old saying, you sell a 17 VIX all day long, but you get to a 23 VIX and you better pay close attention, because that could turn into a 30, 35 plus. Because of exactly what I'm talking about. Either, we absorb concern, as markets often do, or it turns into something a lot more serious. So the question is, well, what do we do at this point? So and this is your VIX gamma as well. You can even do this in the VIX complex above 20. We have all this negative gamma. Because why? Because everybody's buying upside calls to protect themselves, and that leaves dealers short those calls. And that's what happened in early August. Everyone's like, well, what happened? Why did we spike so hard? Well, something weird is happening out there. And some smart people, McGillicuddy and a few other people, Rubner, they've talked about this. What is happening in markets?
Scott Rubner from Goldman and Charlie McGillicuddy from Nomura.
Yeah, from Nomura. Really, really smart guys on the derivative side. And they've talked about, look, what's happening out there? Is it something to do with GFC vol budgets? Does it have something to do with, banks and desks being less prone to building up books, right? We've had this sort of limitation on how much risk they can take on, and et cetera, et cetera. So is there something going on that can lead us to an early August type swoon where, frankly, it's like a lot of people trying to get through a very narrow exit suddenly? And so that's the question. So how do we protect ourselves for something like that? And so we always want to have protection on. And up to August, I think 6-month skew on the S&P was at multi-year lows, like 7-8 year lows. And so that meant that nobody was buying protection. Nobody felt like they were ever going to need protection. They owned homes and they didn't need house insurance suddenly ever again. And that's also part of what happened as well. So when you have everyone tossing protection out the window, when it's necessary to have it, you have too many people trying to grab it, and that pushes the VIX up and the whole futures complex up. And so, what do we do here? Well, we've got an expensive market, not insanely expensive, but pretty expensive. And we've got a couple interesting things. Like I thought this was kind of cool looking at the energy space. I thought there were some interesting ways to line up with geopolitical at this point, given that energy is, and I know you're sort of bearish on energy longer term, but in the short term, you're feeling like there could be a reactivity to it because of what's happening in the Middle East, right? So short term, anything can happen. So I think I was sort of thinking that might be an interesting place to create a little bit of a trade. Because, and this is sort of part of my process, I start to add up the layers of edge. So I say, okay, well, could there be a tendency for people to want to get back into something? Well, as we saw with China lately, it was the most under-owned thing on earth. And sure enough, we're up 25, 30%. So suddenly, you know, it's not, I mean, it took a lot to flip that switch. It took a lot of bazookas in China to get things going again, but people have been piling into something that they ignored for quite a number of years. So could energy be an interesting spot? Well, combine that with the geopolitical that's going on. And then I start to get into, it's very underloved. And you get into the skew. So I'll go in and I'll look at the skew and I'll say, well, it's very flat to the upside. So I put on a trade today. It's already up a little bit of money where I sold an out of the money put spread. So I sold an 88, 83 put spread on XLE. I think I went November. And I used that. And so what I said was, look, the skew typically is kind of steep. And when I say skew, that means typically you get puts being more and more expensive, relatively speaking. It's fairly flat right now. So I thought, okay, well, let's sell the nearer the money put, buy the other ones. It's not going to get as expensive as it normally is, but we've seen vol really push up into this event, right? So this is your 52-week range of where XLE volatility is and the skew. And here we are up here. So there's no question, everything's been pushed up. TLT vol is up, XLE vol is up, equity vol is up. It's all up. But we can use this put spread to finance the upside call spread. And that's what I did today. I played some upside by selling some downside. And so the upside is also a little bit, we call it flat on the call side. And usually it's sort of downward sloping, and right now it's flat. So that plays even better into the strategy as you buy that call and sell a further out of the money call. So I like to look at these kinds of setups, first of all, from the broader idea. Like, it all starts with the idea. When you trade options, the number one thing is, well, what are you trading? You're not just going to, I mean, unless you're a pit trader and you're sitting there just kind of looking for tiny little kinks in the curve and all these esoteric kind of things, you're going to be starting with the storyline. There's got to be a storyline. Then you start to dig a little bit deeper. We look into the vol. We use some interesting tools to look at where the curve is, to look at where the upside and downside skew is. This is kind of interesting here, Samantha. We can see that we've gone from that period of nobody needing any insurance whatsoever to, here's a better one.
Yep.
Here's 3-month put skew. So this is basically your 25 delta out of the money put versus the at the money. And look at that. Look how panicky things have been lately, ever since that August date. And what I find is very interesting. So to your point about where can we hedge ourselves, what I've been looking at and where I've been trading, I took off a VIX hedge trade yesterday for like 126% profit. Now that's a hedge, right? I'm also getting hurt a little bit in some names, but that's what the hedge is for. And so look at this. What this is showing here is the reactivity, the reactiveness of VIX futures to a move in the S&P. And it's very, very heightened. What that's saying is it's really on edge, right? So here's your VIX intraday beta to S&P. So your beta is 99th percentile, 98th, 99th percentile. That means this market is on edge. And particularly in the protection space, in that world of protection, this market is on edge. And that has to give us pause here, right? As much as we think, okay, 6,000 is coming at some point. As it is, if we're, that's from the forest standpoint, but in the trees here, we are seeing a lot of problems. And so I would say that you're getting a good kind of bang for your buck, even though the VIX complex is expensive now. It all is, right? S&P downside puts are expensive. VIX it's all fairly expensive. So you want to use call spreads. You want to use things that kind of offset some of the cost. And so if you were to go in and buy like a 25, 35 call spread in November VIX, that could be something that looks interesting because of that reactive aspect to the VIX right now. You're getting a lot of beta to these moves in S&P. So that makes that more interesting to me than downside puts.
I love this. It also aligns right now. I saw last week, in fact, I posted this, 100 percentile for both JP Morgan and Goldman. hedge fund long positioning. So speaking to the where are the hedges? And then we had this yesterday, escalation news right after the open, and they're clamoring very, very quickly. And they were large size bets that came in. In fact, there were 50,000 contracts that hit for March 2025 SPY in the 572 region, right? Something like they came in very quickly, realizing we better take care. We may still be going up to 6,000, but I don't have any tail risk hedges on. So that's excellent. That's proof that the market is still bullish, but off sides if something does go awry. So
yeah, you're right. So here it is, Samantha. We've seen we've seen China upside. So we've seen some amazing resilience in that China trade. There, I mean, most of them are closed, or Hong Kong's open, right? But
Hong Kong, yeah.
Yeah. So we've
This
seen
is
some willingness. There's been a little rotation of sorts. We haven't seen a rotation like this in a long time, but out of US into China a little bit, which may keep a little bit of a cap on things, right? Maybe that keeps us from getting too far. Although this China trade is kind of getting a little bit long in the tooth, not
a
long
little
term.
bit.
I think it looks interesting long term, but yeah, 29%
Okay.
is pretty good. Yeah.
Yeah, I think it's parabolic, and it will
Yeah.
definitely, as I like to say, parabolas are actually trapped longs, and they're looking for a
Right.
volatility trigger for a liquidation event. Now, this is different. This was a very, very oversold, unloved, undervalued sector rotation theme of gusto because of, yes, lots of monetary stimulus and then followed by fiscal stimulus. And luckily, we were already in this, right? So this was ironic that not only do we have someone Jeffrey Fougre, who is our economics advisor, who has been extremely focused on China, specifically BABA and some other arbitrage plays. So that worked out extremely well for Edge clients. But I happened to just on Monday going, I think this is ready for a squeeze, and posted that on our YouTube channel, actually, for 3 particular stocks. And it was a question in here, was that a gamma squeeze? It was more than that. It was really a tinderbox waiting for any flows to come in. And because it was just the perfect storm of again, money looking for a home. They don't want to keep crowding out the Mag 7, right? They've already extended a lot of the defensive sector rotations in the safety non-cyclical plays. So China got some positive news, and money just rushed in there and swamped the flows. That's the macro trigger that basically also squeezed those shorts. So to say it's a gamma squeeze that's one of the results, but it wasn't the reason for the season. It was definitely, there were no flows until everyone, hedge funds, oh my God, we're underperforming. Here's a fabulous, sector, Tepper's all in because of monetary fiscal stimulus. So anyway, that is that rotation, which is parabolic, and I think needs to digest right here, right now. So it's reached my price targets. But you're talking about hedges that are coming in besides the VIX, which you've done. And I think you also talked about a SPY hedge, which I want to talk about because, again, I still see some very large positioning, not chases. We're not talking this week or next month, but they're coming in for protective puts out in March, just in case something happens, or right after the election through December year end, just in case something happens. And yet you spied a big VIX trade that was actually showing compression of VIX, the IV crush that happens after, after the election. So, but let's just assume right now we're putting on some hedges. What are you recommending as it relates to SPX or SPY? Because small caps, as you said before, are not really my cup of tea. So.
Yeah, I know. You don't love the small caps, that's for sure. I mean, I think the small caps are kind of look, it's all expensive. The skew is very expensive in QQQ, SPY, IWM. So it's across the board right now. You've got some pretty costly skew. So nothing's super cheap at the moment. So I think you basically have to kind of spread it out. And I think it's important to kind of think of your your sort of time horizon on this? Is this something that you want on all the time, or is it something that you want to just get you through a period? I think a lot of the flows that I'm seeing are thinking probably what everyone's kind of thinking, which is, look, if we can just get through this difficult period into November, then the coast is clear for, eggnog and merriment, right? Towards the end of the year, as we often get. And so you're seeing a lot of very shorter term positioned things. Although the trade that you're talking about, this sort of vol compression trade, was in December. So that's going to play the compression. So some people are thinking, I need a short term hedge, but then I'm going to play the vol crush afterwards. So this is kind of the playbook right now. Let's get through something difficult and the election and hope that that goes over fairly smoothly, which is, there's no guarantee of that, but we're going to come out of it with the president probably, and then we're going to get this big, vol crush as managers kind of scramble to do what they always do, which is, because they're all, 95% of them underperform the index, and so they have that moment every year where they go, uh-oh, I can't quite talk to clients and tell them that I don't own enough Nvidia or Microsoft or whatever it is, and so it's a big scramble to buy some of these names that they need. So downside put spreads, good way to go at this point. Those upside call spreads in the VIX, and we're seeing, what was the flow that I saw yesterday? Mostly October, November buckets. So that's what I'm talking about. People are looking at the OCC 25-45 call spread, OCC 20-30 call spread, 20,000 times, 25-35 call spread, 16,000. So very, very concentrated in that worrisome part of the remainder of the year. And then beyond that, it's that kind of vol crush. Now, what I usually show people, when people ask me, and I work with RAs and people who just need to think of hedging and they don't think of that naturally, is I just say, listen, when the VIX is lower, you probably don't want to do it now. Although when we talk about the VIX, remember, that's 30 days. You're not looking out very far. So what happens in the VIX doesn't necessarily happen in the 1 year sort of term duration for, so you kind of have to look at the full curve for that, right? To see what's going on in 1 year options, for example, or 2 year options versus what's happening. The front, it's almost like a whip. The front gets moved around quite violently in these kinds of situations, the back not as much. But when things are relatively calm and the VIX curve is in a nice contango and everybody's happy and stocks are just kind of moving up slowly, then that's when I tell people, get in there, look for probably 15% out of the money puts. And the reason being is, if you're involved in equities, you're not going to be too concerned with a 5 or 10% sell-off. It's never fun, but you're not going to be all that concerned. If you don't want any volatility, don't be in stocks. But if you're involved in stocks, don't overpay and buy puts that are too close to where the market's trading, because you're just going to pay a whole lot for all this kind of, this kind of beta to the downside, which you might not necessarily need. What you're more concerned about is, what if something catastrophic happens? That's where you want to place your insurance, at that point where things are starting to look a little bit more like we're not understanding what's going on. 5 to 10% we can understand, because that's par for the course. Historically we've gotten sell-offs like that, 1 or 2 every year, in most years. So what we're more concerned about is when something's going to turn into a 2008, 2009. And so that's what we're kind of hedging for. Remember, we trade what's in front of us, but we hedge for what we don't see, which is that kind of potential downside move. So 1 year, I tend to focus 12 to 16, 18 months, 10 to 15% out of the money puts, and you kind of set it and forget it, and then start rolling about the 3-4 month mark to expiry. And then you just kind of keep that game going.
Excellent. So I wanted to just bring up this chart. I know we're kind of going back and forth, because you were just talking about hedges and the process that you use and employ to kind of roll up, to set them and forget them and roll them. But you had previously talked about an XLE. You're selling a put spread, buying a call spread. And one of the reasons why I bring this up is because as we talked yesterday about crude, this is on a 2-hour chart, but just to kind of give you those watching a feel, this was the, a little, and it had a little shakedown. But the bigger picture is it is supported, looks like we could go higher if we were to have a geopolitical event, how best to play that. You put on an XLE tactic, which I like, although, as you also said, big picture, I'm bearish. That's on a monthly chart. But for this XLE, just a simple little technical analysis using this time frame, right, of weekly, daily, and hour, we came right down to a 100-week, which is very supportive. It's a great place for a bounce. And XLE has, large cap weighting of Exxon, for example. But the point is, this is definitely trying to get back above. So you're playing XLE for a breakout higher in crude, either because you like this sector, because you like the skew, because it's also a proxy for a potential oil spike, correct?
It is. That's sort of the number of layers that you kind of like. I've been sort of thinking about energy because it is underloved lately, and now we kind of have that sort of fuel, that accelerant, right? We talked about that accelerant with gamma. When you can add that potential accelerant to the situation, now you have something that's starting to build up to an interesting storyline, a more interesting storyline. Because XLE, to be honest, has been a little bit of a heartbreaker, right? It kind of gets going and it keeps failing every single time. But you're right, XOM starting to look really good.
So the reason I point this out, though, is big picture, the energy sector was a huge focus of mine in fall of 2020. Both uranium and energy had a big call that energy would outperform, and moving forward, oil as an inflation hedge, basically, that's how it actually gets acquired as a way for firms to actually play inflation is through the energy sector. So it worked out brilliantly for 2021. 2022, we had the drama of course, Russian invasion in Ukraine, and we did spike all the way back up here to 130. Note, this is on a monthly. But the reason why this chart has my attention is because big picture, it is failing major support. And we also have this introduction of EV, 50% mandate in China. It's spreading. We have, it isn't about supply interruption. I have a kind of a motto that demand destruction trumps supply disruption. So we actually have a lot more substitutes. So the point is, I still see the oil market itself under distribution and very likely breaking down below my key 65 monthly support, right, which is where we just got defended the past few weeks, and falling into this 40 area. It seems shocking, but not really. You're always going to find a narrative out there for bullish or bearish any commodity. But the point is, this is mine, and it also plays into my lower yield call of the 30-year pulling down with the 10-year into lower levels, which would support my warm summer housing market call that I made into, in this summer and next summer. And that has happened, right? 30-year fixed income, rate came from 8%, now near 6%. So they're related. But that doesn't mean an XLE trade can't work in the near term, right? Especially on a geopolitical risk with oil spiking higher on potential retaliation, not in high potential now, growing high potential retaliation. So I'm not going to be dogged and say, no, I only see oil lower. No, I see this as a spike higher that gets shorted. But you're playing for XLE for lots of different reasons. Exxon looks great. XLE is a great proxy. It's underloved right now, et cetera, et cetera. But it's also a play on a rotation higher in inflation. And I don't see that. It's also a rotation in value over growth. And right now we're still kind of duking it out. And so it's still a great viable trade setup. And especially the way that you've structured it, there's lots of flexibility there to play amongst that sold put spread and call spread. But ultimately, it needs to break out and above, right? It needs to break out and above this trend line on a weekly. Right. And right now, all it's doing for me is, you can't see it.
Sorry, we can't see what you're doing, Samantha.
What, you can't?
No, go ahead. Go ahead now. Sorry, go ahead.
Okay. This is a 200-day. So there, again, so compelling. But as you also can see, Exxon, though, is looking quite better as biggest weighting within XLE. The problem is it has been up here before, right? 2023, it's been up to this monthly resistance level and failed and failed. Is this time different? So if this can hold above, then yes, I'm very bullish. We're going to have a rotation in XLE. Hopefully that makes a little bit of sense. But I'm definitely bullish on an oil spike in the short term. And XLE is a wonderful way to trade it. But I think a lot of folks will also just kind of be looking at the big picture, which is we break 65, we're heading lower.
Yeah, I like that. And in terms of big picture trades, I kind of like I like your TLT idea as well. I kind of feel like it's certainly not acting like, I mean, that's the one problem with looking at the short side is this potential explosive situation in the Middle East. Of course, they're going to run to safety. But having said that, I've been wondering lately, of course, we're going to get that downward pressure on shorter term yields, but are we going to get the full extent of those cuts that people are expecting? I'm not so sure. We keep getting positive data, good GDP data, good labor data. Overall, things are fairly okay. So I wonder if people are getting a little bit too optimistic on that side of things. And so if that is the case, if you thought that were the case, that TLT could maybe revisit the low 90s, then I think you could look at some things like, downside put spread is one way to kind of play it. The volatility is pumped up a little bit. I had this trade last week before volatility pumped up, before the Iran-Israel situation. And so I had this back spread idea to kind of sell some, 95, 96 puts, maybe buy some downside puts on it. And the nice thing about that is, I've been doing a lot of back spreads lately. So I did one on MSTR. I did really, really well.
Yes, that was a good one.
That was a good one, which is weird. I don't usually play that Bitcoin complex, but it was the same sort of thing. I did a video on it, sort of showing, well, look, here I am kind of checking all the boxes. Okay, here's the idea, here's the name, here's the one within that complex that makes sense to me. It's sort of the best proxy, as opposed to getting into the miners, which I have a position on as well. But the miners tend to be, they're acting a little bit sick lately. So the MSTR is very, very reactive to what Bitcoin does, and overreacts, in fact. So I thought, okay, you have this potential for an overreaction. So, and then looking at the skew again and sort of going, okay, the back spread makes sense. Okay, where's the volatility? Okay, it's very low, because you only want to do that kind of strategy when volatility is very, very low. And then you need things to happen within, a month kind of thing. And they happen. So it's always nice when a plan comes together, in the words of the guy from the A-Team. I love it when a plan comes together. I don't know if you watched that show, Samantha.
I grew up with it. Yeah, absolutely.
You did, yeah.
Absolutely.
Hannibal. I think his name was Hannibal. That's right. I love it when a plan comes together. So, and sometimes we're lucky. It takes a little bit of luck. It takes a little bit, I always say, a little bit of hard work, a little bit of knowledge, and then a little bit of luck is all part of it too. But if we were to go in and look at the TLT and look at like a November, if you kind of thought this has the potential to kind of melt into more positive data, what's your thesis there, Samantha? Is that on the TLT, is that we kind of give up a little bit of the full extent of those rate cut hopes?
No, for me, it's I'm I'm very focused on this range now. I think we have more opportunities elsewhere while it works itself out. In other words, the 10-year between this 3.8 was solid, important support, and it sliced through it, right? So that actually shows me how weak it is. And it gapped down from a monthly standpoint, which shows me how broken it is. So I turned, as you know, right, from not inflationista, but from a very, very much a bond bear into a bond bull back in May. So I wrote my thesis that I saw oil coming down with yields, and that still holds. That hasn't been upset, hasn't been negated. So I see this counter trend pullback, which I literally wrote about the morning, right, of September 18th. We're going to have a yield spike now. So this is just a counter trend pullback in bonds. And I think we're going to actually we could come back down to the 200-day, which is like, 94, 95 area in TLT. But so far it has hit two of the price targets. It can overshoot to 96.40. That's what I told clients. That's what I have it set up to do. And then we could even get a little bit further in this pull down while yields move higher. But I don't think they're going to get above 4.09 or 4.1.
Are you showing the chart on there, Samantha? Are you showing the chart? Sorry, do I see
No,
the chart?
no, sorry about that.
Okay.
I'm looking straight at it as I talk. So anyway, but you know the area. So the point is, I don't think that we're going to have a yield move above 4.09. And so wherever that level is, wherever that lever is, that's where I think bonds will reverse and move higher again. So that takes us kind of into the end of the year, right? So at the end of the year, we've got this chop where bonds are coming back down with the yen, and that's supporting, right, this kind of market that we have in equities. We're not falling apart. I firmly believe that if oil breaks 65.65, crude breaks 65.65, if we go back and yields get below 3.8% solidly, 3.6%, that trifecta, there's also jobless claims and unemployment. We push higher of a particular level in jobless claims, which is 267,000. We're not there. We're like 216, not 267. But the point is, those three things will pull forward recession risk. Right now, we're grinding with all this market has with optimism into Q3 earnings, which are going to start right up. And the bar has been lowered, so stocks should beat. We also have the election. Come on, they're not going to let the market fall apart. We need a macro trigger to force more volatility harvesting. And you've proven they're not buying hedges unless they have to. So the market is very complacent to tail risk. And that means there are opportunities for the VIX to spike like it did on August 5th, although that was triggered by carry trade unwind. It's very, very clear that yields crashing with the yen was upsetting the basis trade. The basis trade is where they're shorting those, the treasuries, and they're going long NDX, their VIP stocks, and then treasuries start rising up and they're selling their precious Mag 7. So that was just appetizer. Right. So we could have much more of that as the year continues in 2025. But right now, they're going to keep it together. They're doing a global, rate cutting regime. Central banks have already started before the Fed, in large part because credit demand is falling. That's absolutely telltale signs of why they need to cut. So it's 50%, 50 basis point was, sold as a victory, sold as normative, where the rest of the world is actually trying to compete, right, with this very aggressive.
Right. Well, this is sort of the strange situation is you've got bonds sort of almost pricing in a recession. You've got bonds pricing in a recession. You've got stocks pricing in, not the roaring 20s, but growth and everything's fine. And there's some signs, small business confidence really coming back. I think that's an important thing. But you kind of have these two worlds, and it's bonds pricing in a recession is supportive of stocks in a way. You're going to get you get rates down, and suddenly stocks can kind of take off again. So it's almost like you're right. They're throwing everything at it. They're starting to spike that punch bowl again, and you're going to need that. You're going to need something to happen, that macro event. And I almost wonder if we might have some indication that profit margins are going to be pressured a little bit because you have inflation coming down. That's, to me, except for the very, very strongest companies who have those incredible moats and brands and can charge anything they want. Like, I don't know if Apple is still in that category, but charge whatever they want. So they're going to have that sort of stranglehold on margins a little bit. But for everyone else who is just able to kind of raise prices willy-nilly, I wonder if there's going to be a little bit of compression in those margins. And that might be because, of course, you've seen the chart on profit margins. I mean, they're through the roof. Times have been fantastic. COVID was bad, but not for companies. Boy, they sure did well.
So one of the reasons why I think the market has a hard time pricing in this Middle East war is because they don't know how it's going to affect corporate earnings, right? Top line, bottom line. It's early yet for them to kind of figure out how this is going to affect earnings. It's a little bit easier for me to talk about oil, as a short-term spike, given the very strategic assets like the Karg Island, oil platform in Iran, if they were to target that and the effect on oil supply. But big picture, oil is a mobility trade. So the less people travel and the less industry that occurs, it actually reduces the demand of oil. So I can kind of parse all that out as common sense. But when it comes to the bond market, I think it's much more complex and nuanced. So I happen to think negatively about next year's economic growth, about rising unemployment, the Fed rate cuts, obviously, globally, are credit demand falling, bank lending contracting, net interest margins also falling. These are things that are lagging. In other words, we're not going to feel the effects until next year. The cyclical rotation with the AI hype basically wearing out and then rolling over. This manifestation of concentration risk in the Mag 7 because of the things you just talked about, right? Which is that big moat and the earnings power, the pricing power, et cetera. This, unfortunately, it's still a carry trade. So this is not done. The yen carry trade, the oil carry trade, the treasury carry trade, they're all part and parcel of a massive leverage on the system that does invite need for hedges, which is why I'm really glad to be working with you. And clients have benefited because when we did have the volatility come in on August 5th, you're like, okay, now, whoa. It's okay, but we're not going to get above 65. Right. And you calm clients down on that Monday morning. I was on vacation. Thank you. And then, just recently, your very balanced view in how you look at volatility and hedges and when it makes sense to press, right? Not just to have them on all times, but to continue in certain, situations where you need to actually go directionally short and add to your hedges. So for me, I don't think we're there yet. I think tail risk, absolutely. Market rolling over hard, we need a macro trigger to interrupt the bullish flows, just like you said. I think we will have plenty of reasons, depending on, of course, election, tax, harvesting, and a lot of risk moving forward. There's no question, even if it's split government, which is very bullish, typically for Wall Street. I think we have more event risk and volatility risk moving into not just the next few months, but from my intermarket analysis, we go into these phases, right? When we get policy intervention, we get a bullish market. 2013 QE, 2017 QE, the October 2022 low. Oh my God, that put a bottom in, right? After that fall of 35% in NASDAQ over 2022. Yeah. October of 2023 was the low before the November 1st Fed pause and Yellen Yahtzee with the QRA, which is Yellen issuing more T-bills, short duration bills, then longer duration notes and bonds. And then, it goes on. And then, of course, the announcement of the Fed cut and the animal spirits are, excited again. So policy intervention, however, has diminishing rate of return. And that's what I'm seeing. The energy that is being expended to hold up the market is actually getting us less and less and less return with each policy intervention. Now, I know we're getting completely off on the talking markets through options, but that's what I'm looking for, are the big positioning pieces that come in towards next year and just getting through this one. So for right now.
And I think, well, I agree. I think my policy is bet on the punch bowl. I bet on the punch bowl and I'll hedge for the other stuff, right? Because I know they love to roll out the punch bowl. The bigger, the better. And so we have a little bit of that going on. So why not play that? I think it's tough being a perma bear because you're constantly betting against, structurally difficult things to do, which is, people buy, they invest in stocks, they get their checks, they invest in stocks. But beyond that, you're just betting against a very long-term trend of things doing fine. So the perma bull, the perma bull stance is very, very difficult. But in the meantime, I think from an option trader's perspective, I like it when vol's very high right now. Movement isn't that high. So you have this nice gap. So For me, I'm going to be putting on an iron condor in the next couple of days. I think that looks kind of interesting because you get that exposure to short vol. Now, you don't want to do that when the VIX is 13, but when it gets pretty
Mhm.
high and the range is probably going to be contained, then it's not a bad thing to do. Also looking at we put on a couple of trades today. I sold some CRM puts. I like put spreads right now. I think when you get the VIX into the high teens, 20s, you're in a much less certain kind of environment. So you want to give yourself that little bit of extra protection. So instead of just selling an out of the money put, cash secured put, I like to do the put spread a little bit more because you get that downside piece of protection just in case another shoe drops somewhere. Because what the vol market is telling you, and so this is one of the things that I live by, just having done this for so long, is I have a number of risk gauges, and right now my risk gauge is risk off. So I'm not afraid to get involved, but I'm definitely a little bit more careful because what volatility markets are telling you is that they're very, very nervous. And particularly the VIX futures are telling you the smart money, if you want to call it that, is very, very nervous. Now, are they going to be completely wrong? I also love that old saying, that Mark Twain saying, which goes something like, of all the worries in my life, most of them never happened. And so I have that on a post-it note practically on my computer screen because a vol seller needs to live by that. You under realize the worries that are always out there. We always worry about things, and oftentimes they don't come true. They don't come to pass. And that's why volatility selling can be a very powerful thing. Generally, vol is overpriced. Options are overpriced. And so there are ways we can do it, but you have to do it in a smart way and also have to recognize the environment you're in. And right now, we're in a very uncertain environment. So you cannot just stick your head in the sand. You have to do it the right way. And you have to have your stops and you have to have your management involved, your risk management and your money management involved, because anything can happen in this kind of market.
It can, and that we saw live yesterday from the
Right.
trading room all the way through to the special session we did for clients. And hopefully this is given, we're brainstorming also about how we see respective risk in the time frames and how to protect and particular sector rotation, bond short, oil spike. These are things that we're actively playing right now that clients know about. You have just reiterate been awesome in working with my clients, not just the ones who are following you in our Slack client workspace, but through your own mentorship and education, options education course. So for those who are interested, we definitely have a webpage completely directed, to your programs for non-members. And then we have a greatly discounted program for members. So I just want to kind of let folks know that they can upgrade and get additional options education through you. My focus really is on market timing, sector rotation, stock selection, setting it up with options, and running that live trading room with 10 contributors that are also offering their subject matter expertise. But none of us are offering the options education courses that you are. So I just want to let folks know that you're not just a contributor to LaDucTrading clients, but you're also a partner through your options education program. So just to let everyone know. And that we're going to be doing this every single Wednesday. So feel free, come back, same time, 4 o'clock after the market close, bring your questions. We can set it up, respectively, how we look at that. Just make sure you let us know your time frame because everyone defines that very, very differently. So any final words, Hans?
No, that's it. Thank you. Thank you for the kind words. And what do we have here from Ari? Can you comment on the risks that you see? Well, we talked about a lot of risks. There's a lot of, I mean, now we've got the dock workers, we got the longshoreman issue. I mean, I keep worrying that we're going to get a little bit of pricing pressure at some point. And I wonder if that's why Powell kind of went, oh, hold on a sec. Maybe we'll just kind of watch things for a bit. So I think we're very much in flux, and maybe that's part of the very nervousness of all markets is that we really are very data dependent right now. So I think markets are are hanging on every
By
single
the
bit
way,
of data.
data dependent. You just said something very,
Yeah.
very key for anyone who's still left. That data, when Fed goes into data dependent, those quotes come out because they don't always. They're in a hiking regime, they're in a pause regime, they're in a cutting regime. When they say they're data dependent, that always creates volatility in the market. Carry traders do not know for sure, right, how the Fed is going to. They're not on a straight line. They're off now. And that makes the whole thing, by definition, more volatile. I've noticed that over the years. So policy intervention is one of my laser focuses, right? And when we have it, yes, we have the Fed put. It has diminishing returns, I've noticed, but that's another point. It is very much when the Fed goes data dependent, you will see volatility enter the FX arena, the treasury market, the equity market, because they don't know what to do. So anyway, on that note, we'll pick up some more concepts and option trades for next time, next Wednesday. Thank you so much for joining us for this Macro to Micro Power Options Power Hour. Cheers, everyone. Have a great week.
Thanks, everyone. Bye-bye.
Join Hans Options Education course by scanning this QR code or by clicking on the link in the description. Subscribe to LaDuc Trading YouTube channel for more macro to micro options power hour and other content.